Hi, everybody. Welcome to episode 3 of the Scaling Alpha podcast. I'm joined today by Josh Neren. Josh is a co-founder and managing partner of Bracco Asset Management. He got his start at Drexel Burnham Lambert in Beverly Hills, which is a small piece of Wall Street lore because a lot of people have heard about that firm and kind of the legendary happenings there. Then he did banking and restructuring at Jefferies before moving to the desk as a managing director at Bear Stearns and later JP Morgan. He crossed to the buy side at MSD, running the Alpine Credit Opportunity Fund with his partner, Michael Goldstein, someone he had worked with alongside on deals for 25 years across both the buy and the sell side. The two spun that effort out to found Bracco. He's a proud Michigan economics grad who's still closely involved with the school. Josh also studied at the London School of Economics and holds an MBA from Wharton. Thanks so much for joining the podcast today.
Thanks, Ben. Thanks for having me. Looking forward to it.
You have a very, very in-depth and long background, which obviously is something that's very important as a manager of other people's money. Your early career spans defining areas of firms like Drexel Burnham, Jefferies, and later as a managing director of Bear Stearns and JP Morgan. A lot happened over those years. And how did witnessing those distinct credit cycles shape your personal philosophy on identifying structural risk?
Well, I think it started really at the first job at Drexel. I was in the last analyst class, as you mentioned, and I had the front row seat to watching that firm disappear. And that was quite an experience at the moment, but it really shaped a lot of what I look at today, which is around liquidity and understanding a mismatch of potential significant proportions and really where winners and losers can come from. At Drexel, for example, they had their cash sitting in junk bonds that they were the only ones that traded while they had commercial paper maturing and nobody wanted to help them. But it's basically when you lose liquidity, that's sort of the first step in financing breaking a business. The same
Mhm.
thing happened in '08, which was the same story. I was sitting on the desk at JP Morgan. There was a lot of dispersion between winners and losers. There were funds that lost their liquidity, that couldn't keep up, and they were forced to sell. And there were people who could take the other side and take advantage. So when I think about it, we're always looking at the liquidity for any investments and what kind of structural risk there is to that. So that's kind of where we start.
So, what about the way you think and the way you analyze an opportunity sets you apart in how to identify good opportunities compared to kind of how the average analyst looking at public credit thinks?
Well, I would say a large part of that comes from the experience and the lens we use. When you think about our approach, we try to do two things. We're always bottom up focused. And if we were to talk about how we think about business, that's a big piece of it. But we comes from a macro lens too.
Hmm.
And that comes from my background in different schools and whatnot, where I studied economics with my business partner who spent a lot of time managing a large macro fund and some of my clients over the years. So that gives you the high level business risk. And that's
Hmm.
first step in sort of evaluating these companies. But the
Hmm.
second step is really that fundamental work. And that comes from the lens that I just mentioned around liquidity and then in
Hmm.
depth research, and as well as a more comprehensive view of a 360 view, if you would, of the credit, 360
Yep,
view, if you will, of credit and the
got it.
opportunity.
So you spent years on the sell side, and then you move to manage the Alpha Credit Opportunity Fund and MSD. What was the biggest mental or operational shift you had to make from moving from a sell side role to a portfolio management role on the buy side?
It was more of a resetting of my role than a reframing of really how I thought, because what
Okay.
I really was very fortunate during, the largest events in finance to have a front row seat to all of them, especially GFC in 2008. I was covering some of the biggest and best, smartest asset managers. Think Dave Tepper, John Paulson, Oaktree, and my business partner, Michael Goldstein. So I had a
Hmm.
chance to watch them firsthand, how they thought about portfolio risk and how they then thought about individual risk. So that was sort of my lens.
Yep.
Now, moving over to the buy side, one thing that happened is I slept a lot less because I had to take the risk home with me, which you didn't
Yep.
have to do when you were on the sell side,
Yeah.
at least in the sales position, but you live with it. Those are probably two of the biggest changes.
Got it. Got it. And then it seems when you were on the sell side, a lot of the biggest kind of regime changes per se happened, like 2008, for example, right? And you navigated those things. What did you notice about some of the managers you were covering and selling to? and how they manage their risk during kind of those turbulent times that where they're faced with a significant regime change.
Well, I think on both the winners and the losers, it was that existential liquidity risk I talked about. Like I
Okay.
always think about Tepper, and when he looked at credit, he would start with, okay, how many quarters do they have of liquidity so that I can give
Mhm.
them time to recover?
Yep.
And then I thought about some of the other investors, and they were looking at how much liquidity do they have in their portfolio such that they're not in a position where they have to sell. So those were the two different lenses that investors had at that moment in time. And it was exactly the way I looked at it from day one because of my experience at Drexel.
Got it. Yeah, no, that makes sense. A liquidity squeeze has killed many a fund manager. So tell me a little bit about how your background, like from the University of Michigan and the London School of Economics, capped by your MBA at Wharton, how much do those kind of classical macroeconomic foundations that you learned in those places still influence, how you evaluate bottom-up credit underwriting?
Well, I'm not an economist, so I'll be
Yep.
first to say that. I did study economics at both Michigan and London School of Economics, and they're slightly different purviews. I
Hmm.
think it really gives you a basic understanding of the economy enough so that you know when to lean in and out of risk. And I think that's sort of that high level view I mentioned a little earlier. And when you look at London School of Economics, that was more of a global lens. So while that's not specific to my strategies that we run today, it was definitely in a different lens to look at and approach investing. With Wharton, that's sort of where it came full circle. And even though I'd worked before I went back to Wharton, it really gave me a different view of operations and management to pair with sort of the financial analysis that I started doing when I came out of college. And I think that gave me sort of a really well-rounded view of the investment process.
Got it. Tell me about your partner and what roles do you both have, and where, there's the division of labor, and how do you balance each other out from a strength and weakness perspective?
It's a good question. We get asked that a lot, and first and foremost, we're really good friends, and we've been partnering and collaborating before even getting together at MSD. We were partnering and collaborating for 25 years. So he was always had the view from the buy side seat. My view was from the sell side seat.
Hmm.
And he had, as much as I had the macro, he had that in spades because he was managing one of four portfolio managers on something called a cross macro team at Goldman. I think he was managing upwards of about $400 billion of overseeing the allocation process. So he comes at it with that lens. I come at the business much more with the sell side markets relative value lens.
Hmm.
And when you combine those two, it's great. And then we both had this fundamental experience evaluating credits. So we tended to come differently, but then the same if you can think about that as we look at things. And we can kind of finish each other's sentences a bit.
So you kind of come to the same conclusion, but through a different lens of how you evaluated the data and information out there that
Exactly.
led to that place, which is great.
Right.
It's like
And if we don't agree,
testing.
then we don't get involved.
It's like testing your thesis from different angles to see if it's
Exactly.
stronger, which is great. So what was the specific inflection point or realization that made you both decide it was the right time to launch a Bracco Asset Management together? And what year did you launch it?
So it came before that. Bracco launched in 2023, but in 2020, we actually joined MSD, Michael Dell's family office, and started what was a predecessor strategy. And that's really where I guess the lens changed for us in that we saw the markets changing and evolving from both of our respective seats. If you were a large asset manager with a lot of what was going on in the market, you really couldn't generate alpha. The only
Mm,
way you had to manage close to benchmark. You just got too big. And
yep.
at the same time that was happening, dealers like JP Morgan were pulling back liquidity. And if you looked at the amount of liquidity provided by markets pre GFC, the 2020, it had shrunk by 90%.
Oh, wow. I
So
had no idea
dealers
it was that
really
large.
shrunk their books.
Mm,
So if you wanted to be nimble and if you wanted to create alpha, you had to be more nimble. You had to have flexible strategy. So
hmm.
that for us was sort of the crux of it. And then in 2000, MSD merged with BDT Partners and they moved to a much more of a private firm,
Hmm.
private credit, private equity,
Hmm.
merchant banking. And as part of that, we were able to spin out. Michael Dell seeded us to launch Bracco.
Oh, that's
And that for
fantastic.
us, that was a great experience because we actually could execute more fully our view of the world, and we could also do it together without the larger organization and build our own business.
That's fantastic. It's fantastic. So you named the firm after an Italian hunting dog called Bracco, known for loyalty, discipline, and instinct. Tell me about why you chose to name it after that dog and how that traits manifest in your culture and how you manage money.
So Bracco is an Italian, as you mentioned, Italian truffle hunting dog.
Hmm.
And, loyalty is something that we look for. And Michael and Michael Goldstein and I, we're loyal to each other and have been for decades. Discipline is something we respect and are very passionate about in ourselves, as same thing with people who work with us. And instincts are really important. And if you think about a truffle hunting dog, their nose is always down. They're always digging. They're always looking for hidden treasure. So that's a great connotation for us when we think about investing. And it also had a personal meaning too. I'll just give you a little story. During one of my milestones birthdays, Michael and I, with our wives, we went over to Italy and we went on one of these truffle hunts with a dog. Now, I'm not sure he actually found the truffle. It might have been buried there, but either way, it
Hmm.
was a great experience.
Yep.
And then when we were looking for a name, my wife said, "Hey, what about that dog?" And I was like, "You know what? That's a great idea. And who doesn't love dogs?"
Yeah, there you go.
So
So
that's what happened.
it wasn't pulled randomly out of air. That's out
No,
of the thin
and
air.
every season or Greek
Yeah.
god was already taken, so it's not easy to name a firm. But this one
Yeah,
actually
no,
has a lot of meaning to us.
but believe me, it took forever to find Ravella, and different angles, and everybody's got an opinion. So it's not easy to make everyone happy. But this sounds like it came naturally in a lot of ways,
Yeah.
and it's very apropos for what you're doing. And kind of relating that truffle hunting experience to also something you said earlier about the flexibility of not pursuing just one approach. You were built on the thesis that investors should not have to choose between active credit investing and the structural and the transparency and liquidity of public markets. Where do you feel the traditional asset management space falls short in balancing those two needs or approaches?
Well, I think part of my comment earlier was more about, people are in business, they're trying to build businesses and
Yep.
growth is a big part of that. So when it's harder to generate alpha by being and create more revenues for your firm by doing that, then the only way to grow that top line and bottom line is through growing. So, you can't create differentiating alpha. So fees compress. The only thing
Yep.
left to do is get larger. And
Yep.
that's what happened. And bigger isn't better, as I think we all know. And what ends up happening is you hug the benchmarks and you can't create that alpha you're talking about. And then eventually, after '08, the private market started. I mean, Apollo did a great job. I think they were the first to start the, private credit when the banks couldn't invest any longer in triple Cs. And
Yep.
it also solved one of the economics problems. It was a new growth vehicle. The
Hmm.
fees were higher. And while that was great at the moment and you could potentially invest in some names that weren't available, I think sometimes the fee structure is driving some of that growth more than the opportunity set. And that might be why you're starting to see some of that real pushback in private credit today, as people realize maybe it wasn't exactly what they expected on all sides.
So you mentioned private credit, and I totally get money. Capital flows in a lot of ways to where the managers can make fees, right? Because that's what they're trying to drive for themselves, right? Well, there you said there's been a massive shift into private credit, but what specific dislocations or inefficiencies has that created, or opportunities has it created in the public corporate credit markets for you guys?
So we had this conversation a year ago. You probably don't want to talk to me because I was a public credit manager. Private credit is the bell of the ball. But I think this goes back to sort of that first question, which we talked about from Drexel and from the GFC, is the market undervalues liquidity and
Hmm.
always undervalues liquidity. And there's actually a study by these two business school professors. I think Bloomberg did an article. It was called Mark to Myth about
Hmm.
6 or 8 months ago. And we actually did a webinar with them where they spoke about a study that they did on private credit. And
Hmm.
what they found was when you actually looked at capital that was returned, not expectedly returned, it had been delayed such that the returns that were realized, your DPI,
Hmm.
similar to what your returns would have been if you just bought the broadly syndicated loan ETF. So the
Interesting.
point is that so much of the return capital was delayed because some of these credits needed to be restructured or extended and whatnot. So I think the opportunity in the public market today, quite frankly, is that the spread isn't as wide as it used to be with private credit. The liquidity is there, the transparency is there, and you have the ability to do everything you almost could in private in
Hmm.
public markets. And
Interesting.
a lot of the issuers are actually coming back to the public markets now,
Because
which
the return for the risk in private markets is not what it used to be, essentially, right?
yeah, I think there's headline risk too. I don't know that, you want to be locking up a huge amount of capital, or signing up to be, have one institution be the one who controls your destiny.
Yep.
There's negativity there,
Yep.
especially as assets are flowing out of the space.
Yep.
So it's a real
That,
unique space. And by the way, I think ultimately there's going to be both. There's both public and private. I speak to my friends at JP Morgan
yep.
and they talk to issuers and they do both. They
Yep.
offer both.
What-
And there's great, and by the way, there's also great private credit managers out there. My old firm at MSD was fantastic, differentiated approaches. But
yeah, yeah, no,
overall,
it makes sense. I think there's a place, without a doubt, there's a place for both. It's just that whenever there's a new market and a rush of capital, more and more capital pursues an opportunity. Obviously, the alpha is going to be squeezed or reduced. The alpha opportunity is going to be reduced, right? And so the question is, what's the equilibrium, right? And what is the kind of, for the average manager, not the expert or the elite managers or even the terrible managers, what is the expected risk you have to take for your expected return, right? And once you reach that equilibrium point, you have to look at it for private credit and you look at it for public credit, and the type of return stream you're looking for is where you're going to invest, or you may even do both, right?
I still think there's a repricing that's happening in private credit,
Okay.
and it has to do with these interval funds. Again,
Yep.
this goes again, same story keeps threading through this whole conversation, liquidity.
Yep.
So here you're seeing these massive liquidity requests, and they
Hmm.
have 5% gates at a lot of these interval funds.
Yep.
Interval funds took private assets, matched them up with some liquid assets such that if there were redemptions, they could meet them. But
Interesting.
once the redemptions start, it becomes you're in a prisoner's dilemma because they sell the liquid stuff to meet the redemptions. So by definition, what's left is the illiquid. So if you invested in something with an expectation of a return that was partially based on liquid assets versus illiquid assets, suddenly that liquid portion of the portfolio, which was ideally probably a better quality,
Hmm.
is much less a portion of what you own.
Yeah, that makes sense.
And
So
by the way, that's 20% of the private credit market or interval funds.
Interesting. So there's inherent structural risk there compared to other private credit funds that may be out there. So you have to be aware, without a doubt, of what you're getting into. So let's turn it back to a little bit to public credit and what you're doing at Bracco, right? We know that managers are always looking for alpha, and they're looking for a signal that allows them to make decisions about, or at least gives them an insight where alpha may be found, and then you need to actually research it and quantify if there indeed is a true opportunity that you want to take advantage of. So you describe Bracco as a bottoms up approach, but macro aware, and in environments that are heavily driven by central bank policy and macro narratives, which happen a lot. How do you prevent macro noise from overriding the fundamental signal and the security selection you execute based on that signal?
So I think this is really focus of process. And I think you have to have a process in terms of how you approach the macro. And I think if you have a disciplined process there, the noise is less of an issue. So if you're considering, economic indicators, you're looking at, what the consumer is doing, you look at, you know, anything related to liquidity in markets, a lot of the different things that are driving the ultimate outcome. You can set a high level business risk target in your portfolio. And you can also select industries based on where you believe you are in the cycle. So that's sort of that's sort of how we look at macro with that
Yep.
lens. And then I think once you have that, all of the noise around, whether or not we have a deal with Iran or we have something else going on that has not that could drive rates higher or lower, that's less relevant in the positioning in the book. And
Got
that
it.
leads us much more to the individual name selection, which is where, we like to spend most of our time.
Got it. So I'm reading about what you do. It seems that you like to pursue kind of a flexible approach to things. It's credit opportunity tends to move around, like across high yield loans, convertibles, and other possibilities at different points in the cycle. Like, tell us about your flexible structure and framework that lets you go where opportunity is rather than having to force yourself to eke out whatever you can where there's less opportunity.
Well, when you look at these different adjacent asset classes or credit asset classes, the returns
Hmm.
aren't always the same,
Yep.
right? They're just year in, year out, they're just not the same. And there's a variety of reasons. It could be, one year rates are ripping and credit spreads aren't doing much. Could be another year where rates are going the wrong direction and bank loans are a floating rate asset class. So people like those. So having that flexibility on where to go and when is really important. There's also some structural, I would say, persistent structural opportunities in individual markets. And I would point the broadly syndicated loan market as one where you have one really large investor type that dominates the asset class, which are CLOs.
Okay.
CLOs are structured credit vehicles. For those that don't know in your audience, it's basically a 10 times leverage structure where you take an equity investment and you buy a whole bunch of, or sorry, you raise a whole bunch of fixed capital in the form of AAA, AA, and you have a waterfall approach to return that capital, and then you
Mm,
go out and buy the underlying asset, which are broadly syndicated loans.
got it.
And that vehicle, like I said, is about 75% of the investor type in that marketplace. And while they offer a great sort of core and stabilizing force, they also don't invest completely on the fundamentals. So
Mm,
their investment is much more about making sure that waterfall continues. And they have all sorts of rules that they have to follow around, concentration over industry on single names, and that drives opportunity. So I think
yeah.
that's where you can find a persistent sort of differentiator
So
versus
knowing how they behave gives you the opportunity to understand, well, it gives you the ability to understand where structural opportunity lies, right?
exactly. And
Yep.
and by the way, in the high yield market, you've much more today see swings that have nothing to do with the fundamental value either. They're just a little bit harder to spot because you have a lot more of the quantitative funds that are driving flows there that are looking across all liquid structures and strategies to increase or decrease risk. So high yield is just one of those liquid strategies where things settle quickly and they can add risk or subtract risk very quickly. So there you find dislocations as well. Loan market's just a bit more specific to one new.
Yep. That makes sense. So you've repeatedly mentioned on this podcast that you would like to be macro aware, but where you like to spend most of your time is on the individual credits, right? Individual opportunities or instruments. And doing a really deep search is important to you. So, in that process, when tearing through a complex capital structure, what does a true depth of search look like compared to kind of the standard kind of consensus underwriting done by kind of some of these larger monolithic long only managers that what they would employ?
Well, a lot of that comes from, so everyone's going to do a financial model. Everyone's going to read the ratings reports. Most people are going to look at the earnings calls. Most people are going to look at the maybe less so the credit agreements and the indentures, but you really need to go through those in depth. Fewer people are going to make calls to other investors that own the credit. Fewer people are probably going to make calls to advisors. And few people who are making the decision are also going to understand the trading dynamics and the ownership base. And that could again be those CLOs that we're talking about, in a loan example. So I think, you have experience, you have angles, but you really want to get a 360-degree view of the credit, which includes all those things I just mentioned. And in my experience, that doesn't happen on a regular basis, talking to a lot of the investors that I used to speak with.
So what do you hope to learn when you're talking to an investor in an instrument that you're evaluating to potentially own? When you call those people up, what are you trying to find out from them?
It depends on the situation, but if there's something that is trading at a discount and the company's coming up on potentially an event where they have to get a refinancing done, but their bonds are trading at a discount enough so that there could be an effort by somebody to drive a liability management exercise
Hmm.
or hurt one group of lenders versus another.
Yep,
I want to understand all those dynamics. So in speaking with a large lender in that case, I will understand those because I'll ask what their view is. So
got it.
that's where the relationships and the fact that my partner and I have been doing this for you were
Yeah.
kind and you didn't mention how many years, so I appreciate that
Yeah.
to
Yeah.
just
Yeah.
age us. But as long as we've been doing it, we're fortunate, as well as with our analysts, that we have a lot of relationships and we're able to get to those sort of answers probably much quicker than others.
So in a lot of ways, you're looking at, and excuse me if I'm wrong here, like you're looking at supply and demand for that bond at that specific time, and you're trying to find out how how should I say, the ecosystem of people who are involved or can influence that instrument. What are the landmines that could be that they could create for you as someone who may want to own this? Or, tell me more. I'm kind of spitballing here, but it seems to me that because this isn't as liquid as like a stock per se, that there's some extra research that you have to do to really understand what the market dynamics and the holders of those bonds or the lenders, or how what's going on at that given moment, right? Other than the fundamentals of the instrument itself.
Yeah, no, that's absolutely correct. The holder base and who is driving or who the largest holder is often makes a huge difference.
Yep.
There's one particular asset manager in the market that if you see them as a holder, you know they're always going to protect the name. They're going to
Got it.
continue to extend, they're going to continue to roll, and it's happened time and time again. It doesn't mean people won't shoot at it if there's an event or if there's risk,
Hmm.
but they seem to be the 800-pound gorilla. And that
Got
gives
it.
you comfort that that company is going to continue to extend and extend and extend. On the
Got it.
flip side, if you look at a holder's base where you're like, there's a lot of weak hands here, there's
Yep.
nobody who's going to support this credit if it
Yep.
has a bad quarter. I'm going to
Yep.
wait until all the news is out
Yep.
before I step into that name and get involved because I think it's at least a quarter or two before they turn. And I don't want to be there when the next guy freaks out and has to sell down 25 million in front of me.
Yeah, obviously not trying to age you, but that 25 years of experience understanding the market. And when I say the market, the players, the people
Yes,
who are involved in this ecosystem, what their habits are, how they approach things, and then your ability to actually suss that information out through calling a context up that that may either be those holders themselves, those lenders themselves, or someone who may know them who can give you the insight. That you can't replace that experience with just understanding how to underwrite the offering, right?
correct.
It's
Correct.
that is a definitely and very large edge for you, right? That's important for, I
I
think,
like to
for
think
people to
so.
understand. Yep. Yep. Of course. Now, obviously, separately from that relationship aspect of just kind of turning over rocks to find out what you can find, right? You're still doing fundamental credit research. And we are in a very interesting era of AI, right? Where you can parse and scan through massive amounts of information like you've never done before. And we don't know that credit research means doing exactly that, parsing through unstructured data, credit agreements, indentures, earning transcripts. How are you using AI right now to help you with that? And I would also say, what are some of the pitfalls? What are some of the pitfalls of AI that AI may be helping you, but you also have to spend time on ensuring that you don't fall into those pitfalls.
Yeah, it's a good question. I mean, obviously, we're using it, we're trying it and exploring ways we can use it all the time. I'd say at a high level, it kind of lets us start on second base in our work. So if you can expedite the gathering of information, the coalescing and looking for trends in earnings calls and things like that, that's a big speed thing. So
Yep.
maybe it's something that would take a couple of days we can shorten to, a number of hours. So
Yep.
that's really helpful. It does also let us look early and help us with screening names. So, I actually created my own agent that is a hedge fund analyst that
Yep.
I try to run through names like that, we're constantly, screening ideas. And before it kind of gets into the pile where our analysts will do the work, we'll use that to sort of at least take a first pass on something. But pattern recognition is really, that's not something that I think it's useful for yet. It's not really, it can do it, maybe, but the judgment that we have and the ability to see what we just talked about before isn't something that you can put into a model. It's not something that, I can say in every situation. It's very good at things that are repeatable, less
Hmm.
good at things that are not. And that's really where I think the edge is in investing.
Explain to me something that's not repeatable that you would say it does not do a good job at
Well,
in
I
your
think
process.
what we just talked about with the understanding of the buyer base
Got
and
it.
who that is and what their motivations might be at any one point in time. I think that's
Got it.
where it limits it.
Do you have a data feed of some kind where you could see who the buyers are or the holders are, or lenders
It's all
are?
generally available. The nice thing about public markets is everything's pretty much transparent.
Yep.
Some hedge funds don't have their holdings up, but any public mutual fund you can look at it. And that in of itself, and same thing with broadly syndicated loans. If you look there, you can see all the CLOs that own the name, and you have
Hmm.
a very good sense for when those CLOs might be coming out of reinvestment periods, which is another one of those indications that are specific that you have to understand.
But since the AI probably has not that knowledge at its fingertips that you've gained through years and years and years, it's hard for the AI to provide you relevant insight because it's not been trained on that, obviously.
Correct.
Where so
Correct. And I don't know if
you're
it can get trained because that data is like proprietary data that's held out there by Bloomberg. And I don't know when Bloomberg's opening up to other AI engines.
Yeah, yeah. It makes sense. And then but you have that insight just through years and years of being in the market and dealing with these players or parties, right? And
We like
so
to think, yeah.
yeah, so that can help you. That can help me. Very interesting. So you're building custom agents. You're using it to basically save you time on information gathering and to some extent repeatable tasks for things it's been trained on. Are you building custom agents? Do you empower your analysts to do the same? What flexibility do you give your analysts to utilize AI to do their job better?
So we have a quantitative analyst that works with us, and he spends a lot of time looking at the different possible ways to utilize it. I think, but we try to empower everybody, and as part of the that's kind of the depth of search and the digging deep in the Bracco brand
Yep.
is dig deep and
Yep.
do your best and try to find some uncovered gem. So that's what we're trying to do with AI, and that's what we're trying to do every day. And I think you know that's where we'll see if there's differentiation. I'm just at least so far with AI, we haven't really been able to find something that's differentiated
Yep.
investing in credit.
Yeah, that makes sense. Well, you said you wanted to power your. Believe me, I know from the kind of my firm and my background in AI about if everyone's using the same models, well, what edge is there, right? And there's a lot of answers to that, but what you're looking for is not what everyone else can generate. What you're looking for is proprietary insight, non-consensus edge, right? And so when you say you want to power your analysts, right? How do you empower them to use the tools to find that edge, to not just generate consensus insight, but insight that sets Bracco apart? And how do you do that?
It all comes from the prompting, I think. And
Yep.
I think having the experience allows you to have better prompting.
Yep.
You know, at least my experience using AI, the better the prompts, the better the answer.
Yep.
And it's also a lot easier with the better prompts to know when you're not getting a good answer. So I think that's where analysts can be much more useful than the market may want them, or maybe talked about looking ahead. But I think that's a critical part of utilizing.
Yep. It's interesting. I think we went through a phase in AI where everyone in the early LM days was like thought AI can do everything for them, right? Then they quickly realized that AI can hallucinate, AI can generate wrong answers and what have you. And the people started didn't mean people stopped using them. They obviously started using them a lot. But then we're coming out of this phase right now where earlier in 2026 where everyone thought, we create these agents and these agents will replace humans. The agents will be able to do as good a job as expert humans who've been doing something for years and years can do. I think we're finding out over the last few months that is just not true. And I think
I agree.
you've hit the nail on the head. Is that AI is not going to capture your edge, and the secret is how do you use AI? How do you guide it? How do you prompt it so that it can act like an experienced analyst or an experienced portfolio manager when to analyze, to synthesize the information available to it. Sounds like you understand that well, and you're really looks like you're trying to set up your analyst to look at it in that way as well, to really to turn the AI into a truffle hound.
Exactly. That's the goal.
Yeah. Well, that's fantastic. So, let's wrap up here. But before we go, I'd like to kind of look forward to the future evolution of corporate credit markets, right? You know, with that in mind, what is the single most important thing you would want institutional allocators in the broader financial world to understand about the credit markets or about Bracco?
Well, I think I'll stick to the broader credit markets given what we're talking about. But I would say that the risk adjusted returns are always what people talk about receiving. I think there's always less emphasis on the risk part and more emphasis on the returns. And the understated risk that is incredible becoming much more in focus is liquidity, transparency, and access to both. And that, I think, when you think about investing, you cannot underestimate the value of both. And
Yep.
that's really what investors should be putting more emphasis on than they have been, and hopefully will continue. But it's really underappreciated right now. And
Yep.
I think the lens is focusing much more on that. And hopefully that's where we go from here.
Fantastic. Well, Josh, thank you so much for your time today. I really appreciate it. My background, and I mentioned to you before we jumped on the pod that I have a background in hedge funds for many years, and there are a lot of hedge fund managers out there who are just doing what everyone else is doing. And from this conversation, I can tell that you and Michael are doing things different and are approaching this with all the tools in your tool belt developed over 25 years of being on the sell side and the buy side. So I'm very excited for what you're doing. And how would someone find you if they're interested in learning more?
Well, thank you, Ben. I really enjoyed the conversation. And simply go to our website and you can reach out through there, Bracco AM,
Fantastic. Well, everybody, thanks for
or hit me
joining
up
us
on
today.
LinkedIn as well.
We thank you for joining us today, the third episode of the Scaling Alpha podcast, and we'll see you all soon. Thank you.